Realty Income, one of the leading REITs in the market, has reported favorable results in 2022. Despite a slightly challenging economic environment, the company managed to retain an incredible revenue growth with an increase of 61% compared to the previous year. Notably, Realty Income's net income showed significant improvement, surging by an impressive 142% year over year. However, despite these positive financial indicators, the stock price has experienced a decline of around 12.7% since then. Today we'll take a three-step approach to thoroughly evaluate the company and determine their fair value. Step 1. Margin of safety. We'll assess Realty Income's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into Realty Income's financial statement and assess critical metrics and ratios. In step 3, we use a combination of valuation techniques such as funds from operations and discounted dividend to get an insight of the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of the company as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. The margin of safety will be based on the financial ratios, health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. Margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase in the margin of safety, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. First metrics that we'll be looking at are the margin and EBIT growth. EBIT has gone up over the years, going from 250 million in 2013 to 825 million in 2022. The average EBIT growth during this period has been 15%, which is a 5% deduction from margin of safety. Margin over the years has gone down significantly, going from 33% in 2013 to 25% in 2022. The average margin decline is minus 2.8%, which is a 5% increase in the margin of safety. Next two metrics are the dividend growth and the debt to EBITDA. The dividends have gone up over the years, going from $2.92 a share in 2013 to $4.08 a share in 2023. The yearly dividend growth on average during this period has been 3.5%, which is no change in the margin of safety. To get the debt to EBITDA ratio of the company, we take the debt of the company minus the cash and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Realty Income, this is over 6 years. In this case, a 637% debt to EBITDA ratio, which looking at our scale is a 5% increase in the margin of safety. The following two metrics that we'll be using are the occupancy rate and the rent reversion. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. In this case, 99% of the property of Realty Income is occupied while only 1% is vacant. Looking at our scale, this is a 5% deduction for margin of safety since it's above 95%. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. For Realty Income, the rent reversion growth has been 1.1%, which is no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of Realty Income. The first valuation model that we'll be using is the price to funds from operations mean reversion. This model is used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to funds from operations ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its average over time. In the past 7 years, the average price to funds from operations has been sitting at $19.59 a share. And the trailing 12 months price to funds from operations is sitting lower at $16.06, indicating that it's currently undervalued. And this gives us a fair value of almost $77 a share, which is an upside of over 22%. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of the REIT is the sum of all its expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. I've imported the dividend payouts of Realty Income going from 2018 to 2022. Average growth in their dividends during this period was just over 3%. And I'm projecting an expected future growth rate in all of their dividends of 3%. I will be using a discount rate of 9% in this valuation, giving us a dividend discount model price per share of just over $70, which is a 11% upside out of this model. And the last model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for the capital expenditures and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of the cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to funds from operations, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers or historical performance. I've imported the price to AFFO ratios of 4 similar companies to Realty Income, and on average, this ratio has been sitting at 16.42, while the ratio of Realty Income is sitting at 15.97, indicating that it's currently slightly undervalued compared to its peers, giving us a price per share of $64.86, which is almost a 3% upside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the price to FFO, discounted dividend and AFFO multiples price per share, giving us an average of $70.63. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth and the occupancy rate, and adding 5% for the margin growth and debt to EBITDA, leaving us with the same 25% margin of safety we started with. And applying this margin of safety, we get a fair value of $56.50. And with the current price of $63.10, we get a downside of almost 10.5%, indicating that's currently a sell by our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.